Hey everybody, there's a lot going on tonight. I'm going to jump right into it with CPI, PPI. We're going to have to talk about Microsoft, why it's up $12, and it's all because of OpenAI. And it does seem like this might be, to me, it looks like it's a discount to the move, but I'm going to ask you to drop your comments in on what you think after you hear why it's up, because you might know something that I don't. As always, I'm interested in what I could be missing, but there's something to this, and I don't think it's I don't think it's actually baked in at the current price point. And obviously, people are going to want to know this because of where it's at, but we do need to cover the CPI data. We do need to dig into that first, and we really got to get into the jobless claims because I don't think people understand how bad this was and how good it is for certain sectors. So let's just do it. Let's take a look at this data before we get into its effects. When the news hit, this is exactly what we saw. 263 on the claims. Forecast was 235. Previous was 237. This was a huge jump. The forecast was 195 for continuing, but that came in lighter than expected. Core CPI year over year, actual 3.1, previous was 3.1. Month over month was 3.3, supposed to be, came in at 0.4. Core month over month, 0.3, 0.3, 0.3 previous. You can see here how the CPI in and of itself, when it's not core, went up. And then, of course, we can see here that the year over year was in line. But really what stole the show was the jobless claims. And it's pretty obvious as why. I took a real quick screenshot of this morning when we first did this because we were live for the pre-market. Right around 8:15 to 8:30, I go live every single morning publicly. But you see this right here? Comes straight across. It actually goes on to 2021, and it goes all the way over until you hit about November. And this is really important because what this is telling you is that's how bad claims are starting to get in the market. That took center stage well over anything that has to do with inflation right now. Remember, the Fed made it very clear what they are focused on. They are focused on unemployment more than anything in the labor market, more than inflation right now. Seasonally adjusted 0.4, biggest gain since January. So it's very clear what's going on here, that we do have tariffs and they are causing inflation. Now, I don't think that that is something that is going to come as a shock to people, but it seems to be shocking to some people that this could happen. And if we really look from when we got liberated and all of our winning, we can see how we just started lifting through that. It's not good nor bad. It just is. And if we just think about it like that, it is what it is. I don't know if we're better off this way or not. I mean, they're taking in a lot of money, but at what expense? Right now, it is definitely hitting the consumers. And that is irrefutable. Unemployment, the labor reports a surprise increase in the jump. This was a huge jump. And when we look at something like this, we have to pay attention to it, meaning irregardless of why it's happening, we must pay attention to it, right? You're moving significantly higher than anticipated. That's not great. You do not want them cutting rates because you're going into a recession. The market will come down hard. It's the only time when you're cutting rates and the market drops is if you have a recession. Does that lead to a recession? I don't think anybody really has the right answer to that yet. Is that the way we're heading? I mean, earnings are clearly saying something completely different, but this is really important for us to monitor. And it's going to be really interesting to see their actions and their statement next week. CPI report has been trumped by jobless claims. Seema's right. Chief Global Strategist, Principal Asset Management. CPI tad hotter. Nobody wanted that. Does it even give them a minute to hesitate? No, not when you see that claims number. Our number was anything over 250, and this shot right over it, like right over it. Here's CPI, and you can see the month over month, and you can see exactly how you're coming in. And this is a really, in my opinion, as I stated, hot number, and it is. So we can't pretend it's something that it's not, right? And we can't pretend that the claims is something that it's not. They both are of significance and they both are important. What I do want to show you is what it's leading to. So here is September, and this is Fed Tool. And anyone can go to this, it's free. And here's the chances of them easing. It's actually at 100%. Now, if we go and take a look at this, but when you get to December, it's fascinating. I think it's absolutely fascinating. Because you're getting this move in December that is just really skewed way more than people are thinking. So you have a 92% chance of 1, and you have a 7.3% chance of 2. So you can see the 92%. You can see where we're at right now, which is 425, 450 range. And to get to 400 to 4.25 range, that's going to be 92.7. And then if you get to 7.3 from 8.9, you can see what that's going to do. So what does this really tell us? And what do we really want to do about it? In other words, what is the significance of this? Well, they're at least cutting once. And if they do not cut once next Wednesday, it's a real problem. We'll get into this on Saturday's video. So make sure you subscribe and click all notifications because that comes out at different times. Saturday video is what leads to everything, meaning Saturday's video is the video that I put out and that carries us through for the rest of the week. But that's usually how we start our weeks. Now, this is where it gets interesting. Here's October, 100% chance that they're cutting in October. Very different than what we looked like before. And this, of course, to me is very important. But when we have this range now from where we're at, there's only an 11% chance that you're not going to cut, obviously. But there's an 82% chance that they're cutting here yet again. And then after that, there's a 6% chance that you're going to cut 50 basis points. And this takes us into December. But you can see your target rate here. So they're telling you cut and cut is the way to go. They're telling you that. They're forecasting it. Here's December. Look at where December is. So December's saying at this point that you have the opportunity here for even more. Now, remember, you started at this 425, 450 range. And if one cut is going to get you this 400, 425, two cuts gets you to this range, three cuts gets you to this range. So they're telling you, hands down, that it's 25 basis points at every single meeting at a minimum is baked into this market right now. And I think this is really important. I think this is a huge understanding that we are going lower and that rates are going lower. And therefore, interest rate sensitive names, that entire sector is something that we're going to look at. And this weekend on Saturday, I'll go through a bunch of names that really benefit besides your mortgage companies and the Fannies and Freddie Mays that I've gone through before. There's a bunch of names here that are secondary that I don't think people are getting. And we'll cover a bunch of them on Saturday. One absolute hands down standout that I'm wondering how they combat this, because electricity index rose by 6.2% year over year, meaning your electrical bill's going up 6%. Not really much you can do about that. If it goes up, it goes up. But what's so fascinating to me in looking at it is grades to electricity grid slowing, energy demand, data centers, some of the main drivers from spikes. What does this mean? Well, what are the spikes? It's got to be data centers. I'd like anyone to comment on this and what they think it really is, but I really think it's data centers. But if you have any comments on this, please drop them below. So where does all this lead us? Well, it leads us to the S&P. Now, here is the S&P, and this is the breadth. This is the 5, the 20, and the 50, and the 200. And I think this is super important for us to get. And just lay of the land, like, hey, what's going on out there? Well, we are above 50% on every single one of these. They are all getting stronger. Now, why is this important? Because we're not seeing any signs of recession at all. Matter of fact, we're seeing the exact opposite. You're seeing rotation. Like you're actually breaking out despite people seeing a lot of these names come in. But look at the home builders. Yesterday, when I was talking about this trade, about, hey, you need to look at nail, you need to look at the home builders based upon the PPI data, no one really had any strong sense of it or had any real strong interest. Later that evening, or from today on, all of a sudden, everyone loves the idea again. And a lot of it has to do with because of the home builders and what's going on. And you can see this through the sectors, but even names like DPST, all of a sudden you're having these little reversals. So where does this really put us with KRE and all these sectors? I think it's excellent for them, and I think that they should continue to do better. The real question is how much of this is baked in. I don't think 3 rate cuts are baked into the home builder. That is my opinion. I'm going to get more into it on Saturday, but I see the turns on these. I mean, you can see them. We've been talking about this for some time. You're about 12 months out from when this is going to really start ramping, but I just think that you're not anywhere near where you should be on some of these names. And I don't think this is all baked in. And, time will tell on something like that, and we'll see how that goes. But for right now, I just don't feel that way. And I think this is something that we really have to monitor very closely, quite frankly, because I do think this whole sector is setting up to move. Take a look at the MHOs and all these names. They're all following the same pattern, that curvature. I was hoping to get some kind of pullback, which we will get. We will get some kind of pullback there, and then we are able to take advantage of it. But overall for us, if we understand where the money's going, then we can benefit from it. For example, if we look at something like the home builders, and then you look at these names such as MTB, you'll start seeing these patterns where you have these inverse head and shoulders and you're setting up to break out of these necklines. All these regional banks are setting up again. All of them are. Here's RF. And you can just literally go through the list of them. Here's BK hitting highs again. FCNCA. All these names are just constantly moving and grinding higher from these bottoms in April. I'm surprised this one's not up more, but you can see where I'm going with this. This becomes the sector that we should focus on. So if we're moving there, that's because the 10-year, right? So the 10-year is barely hanging on. In other words, it really wants to break that level, and it's really having a hard time breaking that level. It just cannot get through it. So do we break the 4%? Yeah, I think we do. I think we break the 4%. I actually think that we're setting up to come somewhere down here pretty fast. I think you're going to see in the threes really, really fast, because nothing that's done with this administration or with Itchy's administration has ever been a scalpel. Everything that J. Powell does has been a hammer. It has just been an absolute hammer. And that is the problem. I refer to it as a hatchet. No time in history have we ever raised rates as fast as he did. No time in history have we ever cut rates the way that we've gone about it. There's never been an influx of capital like this ever in the history of the US from when we did the pandemic. And we're not over it. I mean, we're definitely not over it. And when I say to people, we're not over it, I just want to show you what I mean by this. If we look at WALCL, this is the pandemic, and this is what the Fed was carrying on the balance sheet. This is what they injected into the system. Just so people are all aware of when I say that it's not over, what do I mean? Nothing is over. Anyone know what that's from? Rambo. All right, so if you look at this, you put another $5 trillion on the balance sheet. So you doubled the balance sheet in 5 years. This is what was done. And since then, he's been slowly getting out of it, but you added $5 trillion to the balance sheet. So if you take that $5 trillion and you drop it down and you look at where you're at, okay, you've taken less than half of that off. So it's not like we've put this huge dent into this. Far from it. So I think that this is important for us to get, that they still have to unwind for us to get anywhere. Now, if you want to get into this, well, when did this start? Well, I'm glad you asked. Here's the great financial crisis, right? It's like it's just 2 weeks. Anyone remember 2 weeks? So here we are again. And it's just 800 million that we're going to put on the books. It's not much. It's just 800 million we're going to put on the books to get us out of this mess. And then we'll just sell it back. We'll just sell it right back to the market, and the market will buy it. And now look at us. That's $1 trillion. Look at where you are 20 years later. You'd be begging to have $1 trillion on the books right now. See, the issue with this that people don't get is that when they're going up and they're increasing their balance sheet, they're actually out there buying mortgages. That's what they were doing when they were doing this. This is all mortgages, and if we could believe it or not, they were actually buying bond and ETFs. They were actually buying equity ETFs, I know. And so they have to get out of all this stuff. So as they're getting out of it, who do you think they're selling it to? The same people they were taking it from, us. So this all weighs on the market, right? This takes time for them to get through and for them to work out. And again, we could talk about the necessity of it or not. That's not the point of where I'm going with this. Where I'm going with this is, if you have this much on the balance sheet and you have to work it off and get rid of it, wouldn't you want it to be higher? Meaning have a higher value. So when you're out here and you're trying to figure out things like, they want the interest rate down because of the debt payments. They want the interest rate down as well so that the bond portfolio that they have on the books, they can start scaling out of and make a profit. There's more than just cutting that or lowering the debt payments. They have $6 trillion on the books. The majority of it is in some kind of bond or financial instrument. They want to work that off. If they start cutting rates and demand goes up because of supply, right, you're going to need more of something to get the same yield that you were getting. There's all these different mechanisms to it. And I think what he's doing here, or what they've done an excellent job of, is really trapping him into May, into basically just cutting and cutting and cutting. And I think they're going to front load this. I wouldn't be surprised to see 50 basis points. Maybe we don't get it in September, but he will act like a hatchet. People think that he's afraid. He's not. He just wants to make sure that he's right. That's what he's more afraid of. So I do think you can get down to that 350 faster than people think. I do think you can get down to this 329 faster than people think. And if you get down there that fast, well, what does that mean? Well, that means that all these people that are looking at names like Rocket Labs and thinking that this stuff's over, you're just beginning. Or Lending Tree, or any of these kinds of names that are out there that are rocking right now. To me, this stuff's just beginning. You're far from over. You haven't even had a quarter of where you started doing the refis yet. There's a reason for this. Why do you think they want to have such a boom right now in the housing market? They own Fannie Mae. I own Fannie Mae. I've owned it for a while now. And Freddie Mac. And now you're getting analysts that are coming out and putting these things out there and saying, hey, you want to get involved? You want to buy these things? Where were they in November? Where was I in November? I actually waited until this thing was about $7.50, $8. But now it's up almost 100% from where we bought it in the community. But the point that I'm getting at is, do you think that they want to sell these when you have a strong housing market, or you want to think that when you have a weak housing market? You say anything you want about the administration, anything you want. The guy understands real estate and he understands all the mechanisms and all the levers that he has to pull. So when we're talking about cutting rates and people are like, oh, we're doing it to lower the debt, lower the debt, reduce the balance sheet, because you're going to have way more demand and spin off Fannie and Freddie Mac. There's all these different mechanisms to it, and that's what we need to really focus on, and that's what we need to think about. So wrap your noodle around that. There's a couple things that I really want to go over here that I thought were super interesting for you tomorrow. Number one, for some reason, people think that Larry Ellison is going to have to sell Oracle stock to go out there and give money to his son to go and buy Warner Brothers. You could take out a loan. Let's just leave it at that. It's mind-boggling, the complete lack of understanding that people have. But if they're going to, if they're going to be manipulated by a hedge fund that wants to put out a letter to get people to sell their Oracle, even though it just came out and said their, cloud business is growing at 359%. I don't know how else to say this nicely, but more for me. So understand the mechanism here and why this stock sold down. Peace Sky is obviously the creation by his son. This is something else that I own. I actually think it's going to be a Netflix killer, or I think they're going to just absolutely crush Netflix, in my opinion, with the amount of original content that they're going to create. Between Skydance, Paramount, they own South Park, they own UFC in January, the US rights. They're probably going to get the global rights as they start to expire. And now this guy's going to start trying to buy Warner Brothers. I mean, it is going to just be an absolute 100% behemoth. You just borrow money against their stock. These guys don't sell stock. They just borrow money against it. That's all they do. That's literally all they do. Really important to understand that. For me, could this still come down because it ran so much? Yeah, absolutely. They crushed, and people are looking at this, and you always get the people that are a little scared after they make so much because they're not used to it, so they have to get out of that trade. And I do think you saw a little profit taking here today, sure. But I mean, really, in the grand scheme of things, who wouldn't? The big surprise for me, honestly, was taking a look at what happened here with Tesla. And that is very clearly a breakout. It really doesn't get any cleaner than that as a breakout, in my opinion. And I think you have a clear shot here now, probably to that 400 level, which is really where that call wall is. So we'll take a look at that. After hours tonight, you had Adobe. Adobe had okay earnings. I didn't think they were great, but the stock's up probably because it wasn't such a huge disappointment for once. And you have Restoration Hardware that is kind of near its close. Actually, now you're down about $10 because of what you've seen happen there. And they're talking about doing more in the US, which is absolutely fascinating. And if they pull that off and start to become Restoration Hardware made in the US, yeah, I probably would not want to be short this thing anymore. So I'm actually starting to look at this on the long side, even though they came in tonight and they cut because they're moving their transition. And I think that's a really important concept, guys. If more companies do this, they're going to be rewarded. It might take them a year, but they will be rewarded for that. And I do think that's something. Also, Microsoft, you'll see this up after hours, about $12. It looks like they reached an agreement with OpenAI on how they're going to structure the nonprofit. And a portion of the nonprofit is Microsoft, and they are getting some of that, obviously. And now OpenAI is getting like 20%, or of that nonprofit's getting 20% of OpenAI, something like that, $100 billion. I don't know that $12 is really recompense of where the stock should be on that kind of news. They're going to have to walk through that in the percentages tomorrow, but it seems to me like it should be a little bit higher, but someone else might know that, a little bit better than I do. I don't know the entire breakdown of that nonprofit. And if you do have a link to that or something in the comments, drop it so I can do the due diligence on it for tomorrow's pre-market. That is it. Have a good night, everybody.